Hi guys, welcome to your quick market update. Today is Friday, September 12th. This week we received more inflation news from the Consumer Price Index and the Producer Price Index. The Producer Price Index, or the PPI, showed cooler inflation, better than expectations, and this may be telling us there is more margin compression and less impact from the tariffs than many have thought, but it's still too early to tell. CPI then came out yesterday showing hotter than expected inflation by 0.1%, but here's the thing, a lot of this was contributed to shelter, and the biggest culprit was the owner's equivalent rent, which rose 0.4%, and this makes up a third of the report. This stuns me because the owner's equivalent rent is guesswork, where they ask homeowners how much they could rent their home for unfurnished and without utilities. This guesswork then leads me to another report that you know I love, the BLS jobs report. The Bureau of Labor Statistics job report is the estimated monthly report on jobs created. If you have seen any of my videos before, you know I don't love this report because it contains mostly modeling, guesswork, and uses roughly only 5% of actual data. The BLS then releases another report, the Quarterly Census of Employment and Wages Report, which uses roughly 95% actual data. I wonder which one's more accurate. This report shows a much more accurate picture of the payroll growth in the 12 months through March of 2025. This report showed that actual job growth during that time was 911,000 less than what was estimated. That's over 50% less jobs created. So thinking back to the hotter than expected CPI that's also put out by the BLS, is inflation really higher than expected? I guess we'll be waiting for more numbers in the future to truly find out. I'm on the edge of my seat. One last thing, I have been getting a lot of clients asking me about whether rates will go down when the Feds lower rate and if they should hold off on locking. And here's the bottom line. Interest rates have floated down, and that was in anticipation of the Fed dropping rates next week. So it's already built into the market. And here, historically, what we've seen in the past is mortgage rates typically go up after the Feds finally do lower rates. So I always say you want to start locking in today, take advantage of these lower rates, and then ride it out for a longer period of time where I think rates will continue to go lower and you'll have an opportunity to refinance in the future. Anyways, next week is the Fed Reserve meeting where expectations are for that 0.25% drop. They'll also give us more direction on where they see the markets heading and future rate drops. So it should be an interesting week. Thanks again for watching. Appreciate it. Have a great weekend, and we'll talk to you soon.